Welcome to Money Sense, where we go beyond the numbers to help Canadians design a wealthier life. With host Brent Laux and trusted experts Kevin Hagedis and Andrew Roddick, partners at PWM Private Wealth Counsel and portfolio managers with Q Wealth. Whether you're preparing for retirement, designing tax-efficient income, or planning for future generations, financial decisions can be overwhelming. With a spotlight on pension-style investing strategies that prioritize long-term stability, Kevin, Andrew, and the PWM team will share their insights and perspectives to help you protect what you've worked a lifetime to build. Because effective financial planning should feel like laying a strong foundation. This is Money Sense.
Welcome to our Money Sense program. Boy, have we got an interesting show for you this week. We've got a very special guest joining us. We've also got Kevin Hagedis is here, the portfolio manager with Q Wealth Partners, and Kevin, of course, the founder of PWM Private Wealth Counsel. Our special guest is Eric Nuttall. Good to have Eric back with us, a partner and senior portfolio manager at 9 Point Partners LP. Gentlemen, welcome to our Money Sense program this week. And of course, everybody's thinking about what's going on in the world with energy prices. We're going to be talking about the energy market, oil, gas, what have you, the opportunities, the threats, and what's potentially coming next. Before we get started, Kevin, we'll get into you a little bit here, and you can talk a little bit about Eric and 9 Point Partners and how they fit into what you do for your clients.
Yeah, for sure, Brent. I just want to start by saying how happy I am that Eric has decided to join us today. And as many of you have already known, Eric's views on oil and gas are widespread. You may have seen him on BNN, CNBC, or the Globe and Mail, sharing his different perspectives. I've known Eric, Eric, I think it's been for sure 10 years. It might even be longer than that since we first met. And, we use Eric a fair amount when constructing our portfolios. And we use in 9 Point, a fair amount as well.
A good place to start then, Eric. Tell us a little bit about 9 Point Partners LP.
Yeah, 9 Point is an employee-owned firm. We're based in Toronto. We have a variety of different funds, long-only funds such as mine, the 9 Point Energy Fund, some debt funds. We've been around since 2017.
And boy, over the last few weeks with the conflict in the Middle East, we've seen huge swings in the price of oil and gas at the gas pumps, as well as other commodities. So how bad is this closure of the Strait of Hormuz, be it short or long-term implications in your mind?
Yeah, I don't want to sound overly dramatic, but this is clearly the worst energy crisis of all of our lifetimes. What anyone would have envisioned, the closure of the Strait of Hormuz, this choke point where about 22 million barrels per day of oil and product gets shipped through. Nobody in their right minds ever thought that it was actually ever going to close. It was only whispered in the darkest corners of the energy market, and that's where we stand today. Uh, I consider it closed when maybe one tanker is getting through per day relative to normal traffic of 100. So what that means is that flows are down about 17 million barrels per day right now. That is backing up storage as oil companies in the UAE and Saudi and Iraq can't store their oil. They have to shut in their production. So Middle Eastern production right now is down approaching 11 million barrels per day. And a good estimate I saw yesterday from a firm called Energy Aspects thinks that Middle Eastern production this year will be down about 930 million barrels. To put that number into context, during COVID, which was the biggest demand shock in history, we lost about 870 million barrels. So this is the worst case scenario that anybody possibly could have thought of. The world is very quickly running out of short-term fixes. We do have a release of global stockpiles from the Strategic Petroleum Reserve. That it will amount to about 3 million barrels per day. That'll be beginning soon. The United States government has unsanctioned both Iranian barrels and Russian barrels. So that's floating storage. Is only about 45 million barrels that can be used. So with each passing day, this situation is getting exponentially worse. And it's not just for oil, but there's an angle to natural gas as well, which has a read through to petrochemicals and fertilizers and power demand. So this is, again, I'm not sounding dramatic, but this is a really, really profound crisis. It's masked by domestic oil pricing, WTI, trading at roughly $92, $93. There are certain oil benchmarks in in the Far East that are trading at 150, 160, $170 barrel. So that's truer of the physical market for oil. It does feel like there's perhaps an invisible hand involved at the moment in the WTI market. It is an election year. There are midterms later on. A rising gasoline price is disastrous to the presidential approval rating, but it's an inevitability that you'll have the bridge between the paper markets and the physical markets. That bridge will collapse, we think, in the coming days to weeks.
So, Eric, I know you don't have a crystal ball, and no one knows how long this dispute is going to take place, but do you think this is a temporary supply shock, or is it something that could actually reshape energy markets over the next few years? What would you estimate?
Yeah, yeah, I think there will be an enduring impact, and I'll touch on that in a moment. The most informed sources we have access to believe that the closure of the strait will likely persist at least until the end of April. We currently have about 5,000 Marines en route. I saw a headline earlier. There's more troops heading that way. So this doesn't feel like a taco. You know, you can't taco now because what you would essentially do is admit that oil can be weaponized, energy can be weaponized. You leave a half-wounded animal who's essentially laying claim to the strait, charging ransoms to allow passenger ships. So this is not a situation that I think other Middle Eastern countries will allow to persist. And that's why I think there has to be an inevitable conclusion to this. And it's going to take boots on the ground and it's going to take time. The longer term impact, and this is what people aren't thinking of, and I really, as an energy investor, this is what I'm spending almost all of my time on. What does the day after look like? We know the strait will open. There is an out of necessity for the globe. So it will happen. It's just a question of what it will take to achieve that. But what does the oil market look like the day after? I think there's a couple implications to that. The first of which is I think there will be an enduring political risk premium in the oil price. My best guess today is about $10 to $20 per barrel. And so this notion that, well, geez, the strait opens up and the ships start moving and we just go back to how the world was, a month ago. I don't believe in that view. Already this year, it's amazing to contrast 2 months ago coming into 2026. A lot of oil analysts were thinking that the oil market was going to be in a super glut. Inventories were going to approach all time highs. The oil price was going to crash to $40. What the past month and likely the next month will do is we're going to go from we were supposed to be in a glut to now global inventories are going to fall to their lowest levels in many years. So you're essentially resetting the table for when the strait opens. The other thing that I think, and I haven't heard of many people going here yet, is what is the value of OPEC spare capacity, which think is about a 1.5 million barrels per day. Demand right now is about 105 and a half, 106. What is the value of OPEC spare capacity if it can't be delivered to its customers? And even when the strait opens up, you're only a $130,000 drone away from closing the strait again. And so I think that's going to shine the light on oil producers that are viewed as much more reliable, much more secure. And I really think that will put Canada on the map. We shine in that example, and there should be a premium placed on oil reserves in Canada, especially in the oil sands, in the Clearwater, in the Montney, where we have decades worth of inventory in a world where the demand for oil is going to grow for decades to come.
You mentioned earlier it's not just oil, LNG, natural gas. There's been damage at this big LNG facility in Qatar. How do you see all of that impacting the markets?
Yeah, so this is the largest LNG facility in the world. It's 20% of global LNG. Qatar said that the extent of the damage is going to impact 17% of their LNG production for at least the next 3 to 5 years. So this is not an easy thing to fix. So the simple math is that's about 3.5% of global LNG. And what makes this even more dangerous than it does for oil is, at least for oil, there is an SPR, Strategic Petroleum Reserve. It's a short-term fix. It's a fraction of the overall problem. But for gas, there is no SPR. This is a just-in-time inventory global system, and so this is going to have a real impact both on power demand. You've heard of rationing already. The IEA come out and say, people should work from home and not drive in areas in Europe and Asia because we're going to be running out of fuel. We're seeing that in real time. There's something like 140 gas stations in Australia right now that have shut down because they don't have access to fuel. So the crisis is really unfolding in real time. When you think about petrochemicals, you think about plastics, you think about fertilizer production in real time ahead of the planting season. You think about helium production. Helium. You need helium to produce all like the chips for the AI build out and such. And so I think the people are slow at recognizing just how massive of an issue this is.
Let's talk a little bit from a Canadian perspective here. Eric, are these structural advantages today that maybe weren't there in past cycles that may help us here?
My hope, my dream is that what is happening in the world will light a fire under the behind of the government to make them recognize that the world needs more Canadian energy. It needs more Canadian oil. It needs more Canadian LNG. There was a business case after all. Who would have thought? And so there's a bit of a gridlock between the Alberta government and the federal government as we speak. There is this infatuation with, we need to worry about the carbon profile of a barrel of oil and race towards net zero and spend $24 billion on something called pathways, which is a carbon sequestration. We have to abandon all of that nonsense. There is a desperate need for oil at a time when US shale production is plateauing, when non OPEC production we think is peaking this year. Canada is one of the few countries on the planet that has the ability to increase oil production at a time when oil demand is expected to grow to at least 2050. We desperately need more pipe to the West Coast. We need to try to circumvent the US Gulf Coast as much as we can, even though there are initiatives to increase takeaway capacity there too. So I think as a country, we're phenomenally well positioned if we have a government that spends less time on talk and more time on action and actually shows through actions that they recognize the imperative of doing this.
Eric, when you look at valuations of some of our Canadian oil stocks, at this, if oil stays in that $90 range, is there still more upside for these companies? And if so, how much do you think is left?
Yeah, it's so we do measure upsides. We've oil companies modeled anywhere from 60 to $100 oil. We've got internal price targets, etc. What I would say is the for every $10 move in the oil price, free cash flow yields go up roughly 50 to 100%. And free cash flow is our primary way to measure what we think stocks should trade at. Allows us to navigate the markets, rebalance in real time, etc. Our own internal forecast would be at $80 oil, so that's a discount to where we trade now. My best guess is that is going to be the floor going forward once the strait is open and we supposedly return to the new normal. We have names trading at between 3 to 4 times cash flow, anywhere from 15 to 20% or higher free cash flow yields at $80 oil. And so we have names where we still see very meaningful upside, even at a discounted oil price relative to where we are today.
Eric, could you talk a little bit at this point? We've got about 6 or 7 minutes left in our program here today. What you see maybe investors doing wrong when the energy markets are performing the way they are in such a short time period. What do you see people doing that they may regret when it comes to investing in energy right now?
I think the biggest one is practicing short termism, trying to time the market by watching their Twitter feed or, Donald Trump's truth media, et cetera, and not taking the appropriate medium or long term view. It's interesting. There's a stock that we bought about 5 years ago. We bought 9.9% off of a European super major, Canadian company, and we paid 17 cents per share. The stock today, so hit a bit of a milestone. It breached $10 per share. And so if one had the staying power of turning off the Twitter feed, focusing on fundamentals and riding that all the way is just phenomenal wealth creation. We have to do our best as a fund manager to mitigate volatility with daily redemptions, et cetera. And so you don't always have that ability, but it's just to try to tune out the noise. There is a constant negative bias towards oil because typically everybody on planet Earth is hurt by a rising oil price other than OPEC, oil companies, and energy investors. And so it's really trying to ignore the negativity that is embedded in that bias in most mainstream media that you would listen to and just focus on fundamentals. And it's really easy. The demand for oil is going to grow to at least 2050. That's according to the biggest bear in the world, the IEA, the International Energy Association. We just had in Houston this week companies such as Chevron and Occidental Petroleum confirm our thesis, and that is U.S. shale growth is largely over. That's been the biggest source of incremental supply for the past 15 years. That is now done. As a consequence, non-OPEC production in aggregate is peaking this year, so 2026. Well, we only have another 24 years of demand growth. Well, where is it going to come from? And we think that OPEC only has about 1.5 million barrels per day of spare capacity. So it's a very simple equation. Demand is going to grow for decades to come. Where's the oil going to come from? It requires a higher oil price. That's what I would focus on. And so to hire the jockey or to pick the horse to make you money with that thesis, I think there's a lot of opportunity just in simplicity. And it's just trying not to time the market, worrying about what Donald Trump may or may not say tomorrow, et cetera. It's leading to premature aging. The past month has been exhausting, but it's just trying to keep the end in mind and tune out the noise.
Well, and it puts our governments in an interesting position too, doesn't it? That we see these deficit budgets in the West here announced this spring, but I'm sure behind closed doors there are some in those provincial finance departments that are quite happy to see the increase in the oil price to help with those provincial revenues coming in.
Eric, I just got one more final question for you. I've been getting a lot of questions from clients with regards to the AI boom, obviously, over the last, 24, 36 months. The data centers that are being built. There's another one that was announced recently for Saskatchewan. It's a $12 billion investment going into this province. What are your thoughts on the need for natural gas to power these data centers, let's say over the next 5 to 10 years? And what is that going to do for the price of natural gas?
You bet. I'm glad you framed that question in that appropriate time perspective because this is a medium to long term driver of demand. There's nothing near term. The biggest near term drivers of demand, other than weather, is you've got LNG Canada that is ramped up. I think phase two, certainly with what has happened in Qatar, you'll see phase two sanctions. So Canada, we're going to be shipping roughly 6.5 BCF a day by the early 2030s. On top of that is demand coming from data centers. I think it's clear that natural gas is the solution for that. Wind, solar does not work. Like, what do you do when the wind doesn't blow and the sun doesn't shine and you need 24/7 uninterruptible power? Nuclear, the build out is measured in decades. So I do think natural gas is going to be the solution for that. It's still a little early and it's a little less material in Canada as of now than it is in the United States. We do have several competitive advantages, weather being one of them. It's colder, so you have to use a lot less energy to cool data centers than you do down in Texas. But it's kind of a TBD at this moment to see just how impactful it will be relative to more important demand drivers such as liquefied natural gas.
Interesting times that we're living in and what lies ahead. That's about a wrap on our program today. Eric Nuttall, partner and senior portfolio manager at 9 Point Partners LP. Thanks so much for your time and your expertise today, Eric.
My pleasure.
Kevin Hagedis, thank you.
I just want to again thank Eric for being on the program. It's been about 18 months or so since we talked last, and I think the other thing I just wanted to say it's so important, I think, to have an active portfolio manager. I know, Eric, a couple years ago, you kind of made a pivot in the portfolio, reduced your exposure to oil, bought more natural gas, which was a heck of a smart move. So on behalf of PWM and our clients, we want to thank you. You've made our clients a lot of money over the last couple of years. And again, if anyone wants more information about PWM or just to arrange a complimentary portfolio review, you can either give us a call at 306-975-9500. You can also text that number, or better yet, just go to our website, which is pwmprivatewealth.com.
Thank you for joining us for Money Sense, where we explore meaningful conversations about money, life, and the choices that shape them both. At PWM Private Wealth Counsel, they're here to help you build a life as solid as the financial plan they've built for you. And most importantly, give you the confidence to know you're going to be okay. Financial planning services are offered through PWM Private Wealth Counsel. Portfolio management services are provided by Q Wealth, a registered portfolio manager, investment fund manager, and exempt market dealer. PWM Private Wealth Counsel is an owner and partner in the Q Wealth Partnership, where money meets meaning.